Hi, and Happy New Year. This is Moneywise, and I'm Mathew. I spent some time thinking about who I should bring on to the first episode of 2026. And I thought I should bring on someone that will tell you where things stand right now and will do so in a manner that you will understand. Let me tell you, my guest today will do just that. In fact, in a previous episode, I spoke to her in Greek and Latin, and she responded with words that all of you and me understood pretty clearly. Radhika Gupta, the Managing Director and Chief Executive Officer of Edelweiss Mutual Fund, joining me today. Radhika, Happy New Year.
Happy New Year. I am kind of flattered to be your first guest of 2026. I'm assuming the questions will not be too spicy and too mean, but I'm very flattered to be here, and Happy New Year.
And I'm glad that you're here. You know, if you thought that 2026 was going to begin in a normal, sane manner, this last weekend took place, and Donald Trump's administration abducting a president and his wife of a pretty large country. Were you anticipating that? Did you think, first of all, that 2026 would start in a normal manner?
I knew that 2026 would have its share of drama. I didn't think president would be abducted in the first 4 or 5 business days of the year. No, we don't go about dreaming such things. It tells you, I think, that geopolitics can be used in ways that we can't imagine, for economic outcomes, for signaling, and if tariffs and the drama on X and the signaling was what we saw in 2025, this is an elevated version of it. So yes, I think it's taken everyone by surprise.
So the reason I started with that is also to kind of give a little context of where we stand right now, and perhaps to help people make decisions that are informed heading into the rest of 2026. So let me start with that broader view and then delve in. I've read a few of your articles, and you've used Bollywood dialogues.
I have.
And they were quite nice. So let's start with some of them. When you're describing 2026, do you have a dialogue that will describe it?
I think, there's a movie called Jaws, and it says, just when you think the waters are safe. Boom.
So, Jaws, the one with the shark.
The one with the shark, and just when you think that the waters are safe, Venezuela happens. So I think that's equity markets for you. I mean, look, I thought I would break 2026 into 3 parts, and I was saying this even before. One is what's going to happen domestically, which I think will be the most predictable part of it, because I really think that the worst of India domestic was 2025, and the government has done direct tax, indirect tax, earnings will come back. So I think there's that. The second is this whole tariff stuff, which was the leftover from 2025, which you hope will come to resolution and we'll have some semblance of a trade deal. And then the third is the unknown unknowns, the first of which you saw.
Yeah. Okay.
So I see that as 2026 if investors needed a framework.
So and to talk about 2025 and the year that was, I think it came as a disappointment to a lot of people. Maybe they've not lost a lot of money.
Yeah.
Some people have, because broader market funds might have underperformed.
And broader market stocks.
And stocks, but having said that, a lot of people actually saw their money doing nothing.
Yeah.
So why is this also an important phase? If you were to talk, and we'll spend a little time today talking about market cycles as well, but if you were to talk about 2025, I like to think of it as a year of accumulation.
Yeah.
I was very happy that my SIPs were going in at the same level, or maybe even lower than what I paid for the year before.
I think of it as a year of similar word, consolidation. And I don't think consolidation is very bad. I think after a few years of a runaway rally where people have made a serious amount of money, it's a time to consolidate market returns, to consolidate your own thinking about your portfolio, to relook at your allocations and risk appetite. And, if I were to look at it from a market observer's point of view, if I look at everything that happened in 2025 between, a quasi-war with Pakistan, so much uncertainty about Trump, including a major shift in the India-US relationship, a significant slowdown in Q1 and Q2 earnings, the fact that we're only 5 to 10% down on benchmark indices and even broader markets, I actually think it's a tremendously resilient capital market. I think and so many mega IPOs that took up supply, right? So you can't take away from that, right? And maybe the fifth year of FII is not participating in India. I think if this had happened in 2008 or 9, you would have seen an index down 30%. So I think 2025, for everything that has happened, for the kind of cards that you were dealt with, actually was not a very bad capital markets outcome. Investors should feel like few at the end of the year.
Okay. So, but then what does that mean for us in 2026? Because you've been waiting and waiting and waiting for something to happen, for something to give, either on the downside or on the upside. Because ultimately, if there is a drawdown, we've seen it in the past, there are buyers and the frenetic upside also takes place. That hasn't happened. And the move up has also been capped. So how do we look at the start of 2026?
I actually don't know philosophically if you will see very large prolonged drawdowns from an India equity point of view. You may see periods of time correction, and we've seen 15, 20 months of time correction. But if you look at philosophically, the last drawdown where you had time to react, you know what it was? It was 2013.
Yeah.
After that, 2013 was the period where you had a large equity drawdown. You had policy paralysis by August, September. Like, what is going to happen? There wasn't a change of government. You had a significant time to invest, and I know a lot of funds.
The Fragile Five, etc.
The Fragile Five. You had I know a lot of unlisted funds that have invested then and made a lot of money on those assets. After that, you've not had a meaningful drawdown. I mean, you had some mid-cap drawdown in 18. 2020, the market bounced back instantly.
Sure.
Last year also, you had a little bit of a cut in March, April. And then low and below hold.
Actually, November, heading into February, you had actually 20% drawdowns for the broader markets, and then they bounced back in 2-3 months.
And I think the reason for that is the steady increase in domestic capital base. So, I joined the industry in 2017 when the industry's SIP book was 4,000 crores. Now, 4,000 crores to 30,000 crores in 8-9 years. So you've got a very, very meaningful amount of domestic buying. And by the way, all this has happened in a period. You have also not seen in the last 5 years twin buying of FII and DII. It's always been FII sellers, DII buyers. So I don't know if flows continue the way that they are, whether you will see a very long, prolonged drawdown. What you will see is things like 2025. What you will see is periods of time correction, almost irritating, frustrating time corrections. But I don't think that that's what you'll see.
Now, you analyze investor behavior quite a bit. You've written a book. We've spoken about that. The tendency is to run after things that work. And unfortunately, and this is displayed in behavior that is quite repetitive if you look across the spectrum, right? Because you'll see SIP cancellations starting off a new SIP because one fund is done relatively worse than the other. And the result is that you will have 15, 20 schemes that are running consolidated in your portfolio. You have SIPs and a few, the rest are just lying there and you don't know what they're doing really in your portfolio. What are the few things that are standouts for you that you think should be fixed ideally? At the start of the new year, resolutions are being made, and I think that's a little excessive to say that, you make your new year resolution. But maybe somebody listening to this and saying, okay, these are 2-3 things that I can fix.
So I'll give you one, and since I like the movies, there's that song, na baar baar dekho, hazar baar dekho, ye dekhne ki cheez hai. That simple dekhne ki cheez has become 1 year returns. It's obsessive and it's terribly dangerous. I think we've had so many conversations about the importance of constant allocation, asset allocation, holding a mix of asset classes. And then you have silver turning out to be the new small cap, right? I actually went in asset allocation, holding a mix of asset classes. And then you have silver turning out to be the new small cap, right? I actually went in, was in a client conversation where they were trying to park liquid fund money into silver. That's a conversation for another day.
Wow. No, I want to have that conversation.
It is truly scary. And I think the obsession with 1 year returns is crazy. I mean, we launched a gold and silver fund, the industry's first. And I'm not calling bear on that asset class before anything starts. 3 years ago. And Alex, we struggled to collect 20 crores in it. We get 20 a day now.
Wow.
Because 3 years ago, the recent returns were so bad you couldn't put them in a PPT.
Sure, and you're at 65%.
65, 85, I've stopped tracking
You
it.
stopped tracking, yeah.
I think the obsession to try and time, I think we're constantly trying to figure out, and there are so many outlooks and forecasts and all of that published. But I don't think any forecast going into the beginning of last year told you that silver was going to be up 120% and that there would be a demand for copper funds. So I think it's important to have humility and realize that my ability to predict whether it is Trump evicting a Venezuelan president or silver doing what it is very limited, and my ability to prepare is a lot higher. So I think a focus on preparation over prediction, a slightly longer term lens at looking at things, and I think realistic expectations. I mean, there has to be a notion of what is I wrote this in the book too, what is a sane sense of return?
What is that though? And I want to delve a little deeper into this because we're speaking at a time when, and of course, a lot of people benchmark this to nominal GDP, right? And your nominal GDP, for everybody listening who is not an economic student, who doesn't understand this, is your real GDP, which is your country's economic growth plus inflation, right? And because inflation is at 0.25% now, your nominal GDP is now 8.5%, 9%. And so you generally say your realistic expectation for equity should be 1 to 2 percentage points above that.
11 to 12%.
And that's fair?
And that is absolutely fair. And every time I've said that in a bull market, people look at me as if I've, done something wrong. But that is actually fair. See, if structural inflation in the country is 4%, let's not talk about
0.25,
let's not talk
about that. That's an odd thing.
If structural inflation is 4-5% in the country, and on a post-tax basis, you are earning 4-5% above inflation as an investor, that's actually very, very good. I mean, if the largest global institutions I know are targeting inflation plus 4-5%. So we are also not living in an era of the 90s where inflation was 10% and interest rates were 15%.
Sure.
So you've got to realize we've got to set return expectations in the right place. If you set equity at 11 to 12%, and actually, by the way, that is what the long-term return on Nifty is. It's not higher than that.
Yeah, it's about, if you look at 10 years, it's about 13.5%.
Plus or minus 1% is where you are at on a higher inflation base. So 12% is where you should set that. I mean, gold and silver you should set at 10-11%. And of course, it will not be even, right? None of these numbers. The reason these numbers are hard to believe is you never realize them in a particular year. What you see is plus 30, minus 10, plus 100, minus 50.
No, so, and to argue the other side of the question, because people will be watching this and furiously typing in the comment section, what are you talking about? My returns over the last 5-6 years are 17-18%. Why are you saying only 11 to 12%? What do you say to that?
That was a post-COVID return, right? And that was a point-in-time return from when global interest rates had gone to zero. You saw the post-COVID impact. But try and look at anything over a 10-year period, and you're actually not. Try and look at anything over a 10-year period, or try and look at base rates going forward, right? What's the argument for growth? The other thing you can see is earnings growth in India. It's mid double digits. So, I mean, you can't walk away from laws of financial gravity. It doesn't happen. Now, within equities, there will be sectors that have cycles, right? So if you're smart enough to catch defense at the right time or pick up financials at the bottom of the cycle, will you make 30-40% a year? Absolutely. If you're smart enough to time the right point in the commodity cycle, you will make that kind of money, but not everybody is smart enough to do that.
Smart enough or lucky enough?
Or both.
Yeah, because ultimately, if you have to time it both on the upside and on the downside.
There's enough data to say, and I think Morningstar did this study, that if you look at the gap between investor returns and fund returns, because there is a gap between the returns we earn as funds and the returns investors earn, the gap is actually much lower in what I call dal chawal, basic stuff, diversified indices, etc. But if you look at the gap on thematic funds, it's very high. It's 5-6% because people struggle to time.
I actually looked at the data from last month for.
By the way, no asset management company gives you a sell call on any asset class, on any sector fund. We all, including me, we all launch funds, and that's why you need help.
Absolutely. You need advice and you need help. There's a reason why there are, 250, if I'm not mistaken, close to sectoral and thematic funds. It is a highly populated space.
It's a highly populated.
But I was looking at the data for sectoral and thematic funds for last month. I'm talking about the data that was released last month. So for the month of November, and the net number is actually significantly lower than it has been in the past, and that's only because the gross number on the buy side and the sell side were actually very, very high. So on the flexi cap side, you had 9,000 crore or thereabouts, if I'm not mistaken, of net inflows. It wasn't very much on the sectoral thematic side, only because people are buying and selling furiously. Are you surprised?
I'm not, and I think there are two things. One is, some of them have been launched at not great times in the cycle, so they haven't made money and people get impatient. The second is, I think 2025 marked a return to dal chawal in that sense. So if you look at the volume of large sectoral NFOs that were raised in 2024 versus 2025 would have been much lower. In volatile times, people prefer that kind of uncertainty. The other thing in 2025 is it was a year where sector leadership was changing very, very fast. It was a very, very macro-driven year. So you had pharma being a hot sector one month, and then Trump goes and announces a tariff, and there's uncertainty, and then suddenly pharma's in the dogs. So, there wasn't any kind of sectoral momentum that anyone could launch or bet on. So I think it's a combination of factors, but it was a very, very macro and news-driven year.
Now, I do want to also ask you your view on international versus domestic. There are a lot more products now. The industry is moving towards using GIFT.
Yes.
Particularly because the RBI has not budged on that limit. For whatever the reason they might have, the regulator might have, right? So, but there are avenues that people can look forward to. Of course, there are restrictions and there are pros and there are cons, particularly that 10 lakh limit. If you go beyond that, there is a tax collected at source and all of that comes into play. At this juncture, considering the way that markets have gone and the tendency of investors to rush after things that have done well, you were talking about the NASDAQ ETF maybe, or we're talking about an NVIDIA. What would you say about allocation strategy that is simple, smart and pragmatic?
It's the same old asset allocation thali. Look, I've been selling or working with international funds since 2016-17 when we bought over the business from JP Morgan. And at that point, Indian equities were doing so well. Then we had a 200 crore business. Someone told me, shut this stuff down. Who buys international funds? And then we had this period, because we run the largest China fund in the country, Edelweiss Greater China Fund, where China did so well that our call centers would get a tax if there was a holiday on China, saying, Mera NAV kyun nahi badha?
Wow.
So I've seen this, and then we've seen China do badly, and then we've seen a revival in China. So I've seen the peak of investor cyclicality with China, and then of course we have a US tech fund. Again, I think people struggle with the timing of these things, which is why I always say that have international funds as a 10-15% part of your
satellite allocation.
A satellite allocation. And US is definitely a core allocation. I think if you're a more evolved investor, then emerging markets and China can also be a part of that allocation, and don't try to time it. I think people struggle with international funds is they tend to do well in periods where India doesn't do well. So for all the frustrated China investors, they were very happy in 2025, but India didn't do well, and they are in some sense slightly uncorrelated markets. So I think it's a solution. It's a valuable solution if you are evolved. Again, most people struggle to time it. Yes, unfortunately, the RBI has not increased limits. So people like us now have presence in GIFT. We've already offered Edelweiss Greater China Fund through GIFT, and we'll offer US exposure soon. The other thing that I have as a suggestion with international funds is if you are doing it, try not to do anything very, very elaborate. I think with international funds, your objective should really be exposure. It's like when a global investor looks at India, they're rarely trying to do they're really trying to pick out a minor capital markets and insurance ETF sitting in India, because they want broad-based India exposure.
Which is why they gravitate towards the large caps, because anyway it accounts for a large part of the market.
So now think of yourself in that shoes, right? If you're trying to get China exposure, you don't need to get a narrow sliver of the Chinese market or the narrow sliver of the US market or AI beneficiaries or EV beneficiaries. You want broad-based, uncorrelated growth. So that would be one of my suggestions.
And you have plenty of index strategies that look pretty good.
Yeah, you have plenty of index strategies, you have plenty of Nifty equivalents and Nifty 100 equivalents and flexi cap equivalents. So
interesting.
I think the international equivalent, like we run our China fund as a China flexi cap fund.
Sure.
So that's really what you need.
Okay. So we've spoken about a number of aspects. I did want to speak to you about this change that we had in the regulations on total expense ratio, because I know that if there's somebody that can explain this in a way that people understand, it's going to be you, Radhika, because I looked at it. It was a pretty simple explainer.
It's very simple.
They actually also illustrated this, the SEBI, with a table that will explain all of this, but in simple terms, asan bhashe mein, what changes on total expense ratio?
So actually for the consumer, nothing really changes. Net, your expense ratio marginally comes down because there was one component that you paid 5 basis points for, which was exit load. So wo thoda sa chala jata hai. Now, if you look at an expense ratio has two components really. One is what various people who work for you get paid. Your distributor gets paid. Your investment manager gets paid, your custodian gets paid, your fund accountant. These are all your service providers, they get paid. Everything on top of that is statutory levies, okay, which is what Government of India gets paid. I don't get paid that. The distributor doesn't get paid that.
STT, your statutory...
No, it's GST.
Oh, GST, sorry.
It's GST on all...
Right. It's not transaction tax.
It's GST on all this. So on a management fee, you will pay a GST. On a custody fee, you will pay a GST. So there's GST. Sure. Now, the way the old expense ratio is there was an expense ratio which had all your service provider fees plus some amount of GST, and then there was some GST outside.
Sure.
So that base TER was kind of a bit of a khichdi. It had all your vendor fees plus some GST. Now they've said, let's keep this simple. There is a TER that goes only to your service providers, and then everything else is separate. GST.
Right.
So there is a base TER, which is only service providers and has no component of GST. And then there's a whole bunch of GST. And some finagling has been done between buckets without getting too technical, just to make adjustments. The other thing that has happened practically, which is also good for you, is that there was an equity brokerage that we used to pay for buying and selling stocks that was capped at 12 basis points. Now it's 6 basis points plus cost. In practice, nobody was paying 12 basis points. We were paying about 8 including costs. Now it's 6 plus cost. So it's neutral.
Okay.
Net to the consumer, maybe expense ratio has come down a couple of basis points.
Sure.
Transparency and simplification has increased. For instance, tomorrow, if the government is saying GST is going to double on all fees, it's very transparent.
Hypothetically.
If the government is saying GST is going to half, then that is also outside.
It's passed on.
It's just clean. The separation is clean. So you know how much of what you're paying goes to Government of India and how much comes to the service providers. That's it.
And it's an interesting point to end this conversation on. Radhika Gupta, thank you so much for a fantastic conversation.
Thank you. Happy New Year again.
Wish you the same. And to you, dear viewer, let us know what you think. And let us know what you would like to hear on this program. We love to hear from you. Thanks so much for watching. This is NDTV Profit.